So the dealing range high, dealing range low. Why is that a dealing range again? We took both sides, buy side and sell side out. What's the bias now? Bearish. All of this range in here, we're looking for areas that anticipate a run back up into a premium. Short-term high, short-term low, it runs up into a premium here, it sells off. It creates relative equal highs. Sell side's taken here. So once it has taken the sell side here, what's the market likely to do? Revert back to buy side. Even though it's bearish, where's the buy side? Like a neon sign, relative equal highs. Bumps up to it, then does what? You have now a new dealing range. You have a dealing range from low, because it took out the sell side, and the buy side's taken here. So your dealing range is from here to here. What is the usefulness in that? You're anticipating the market to trade back down to a discount and eventually to its sell side. Discount array below 50% of here to here. This fair value gap is a target. So you're going to be looking for areas once it sells off. Here's a fair value gap. Break lower, target, filled, sell side, relative equal lows, tags it. So now we have this dealing range from here to here. Why is that a dealing range? We've taken buy side here and sell side's been taken here. So from here to here, you start doing analysis inside of that range. Look at all the back and forth in here. And then we get to this level here and it's more energetic. When I see that, I identify this as the dealing range high to here, but I will refine it down to the most energetic price swing inside of the dealing range. So I'm going to use this range here from high to low. How's that useful? From here to here, I'm going to be looking for a equilibrium price point or premium to go short, as the bias is what? Bearish. I said we're entering a seasonal tendency here where we go into May where it's bearish. Did it deliver? Of course it did. Now, this gap here, we see it trade up into it here, sells off, comes up into it here, fails to go into it there. But look at all these opportunities where it could have filled in that gap, but it didn't. Broke lower. That indicates to me that this is a breakaway gap. Meaning it's going to most likely stay heavy and run where? In our bias. What's that direction? Lower. So we have sell side below here now. So we expect market's price to trade lower below that. It does so, and then keeps on trading lower and creates a short-term low here, rallies back up into a gap, drops down once more, takes sell side. So now buy side is where it's likely to revert back to. And from this high to that low, that's our focal point for our study. So inside this range, I want you to think about what you see. Study this, pause the video, make notes of it. All right, so I have the chart kind of aligns that we can focus on that range here. So inside that range, we have a buy side liquidity pool right there. It trades up and purges buy side. Why is that likely to occur? Because we're bearish. We're going into a seasonal tendency where the market's likely to trade lower. So anytime it runs back above buy side liquidity, it's likely to sell off. Once it accumulates those buy orders, it's going to target what? The sell side below that low here. And it does so here. So sell side is now purged. So in short, if we're bearish, I like to look for a short-term high taken out and accumulate short positions. Who's accumulating short positions above old highs? Smart money. They held price there. Why? Because they were allowing traders to engage this as what? A bull flag. We were bearish here. The market trades lower, attacks the sell side, runs in, spends time down here, and then we have Friday's price movement. So let's discuss liquidity a little bit deeper. This is what the algorithm does, okay? I want you to think like this, because this is what the algorithm, when it runs certain macros are a short list of orders of instruction. Do this, do that. The if, then, or. That logic behind how the price is being designed, delivered, and booked. We have now a dealing range. This low was taken out here. This high was taken out here. So now we have this high down to that low. How is that useful? So we're looking inside this range here. Okay, this is our specific dealing range. What do you see? Before I go further, wait a minute. ICT, you just said that's a dealing range. Right. These are relative equal highs. It went above into the fair value gap with this here. And we never were able to go higher. So I'm looking at that as that's the cap on the marketplace. And it's likely going to be a breakaway gap. That means it doesn't fill right away until it fulfills lower level objectives on price down here. So what do you see in here? Pause the video. All right, so we have this high to that low. Why am I picking this high? Because it has the most energetic price run away from it. It's the most recent one that has that energy going lower. The delivery of the candles moving away from it quickly. That's what I'm really getting at. So I'm framing it with the logic that this is likely to stay open, not rebalance, and the market's going to drive lower. So our range from here to here, that's what I'm measuring, and equilibrium is here. So above that level, this level here, what are we looking for? Well, we're looking for buy side. So I teach you to look at a range and define it in the scope of premium to discount. Equilibrium is here. And if we're bearish, we need the price to get to equilibrium or preferably higher than to go short. In this shaded area here, why did it not just simply trade back to that low and go lower? Why didn't it do that? Think. That's our last up close candle right before the energetic move lower. Inside the context that this is likely a fair value gap that is going to stay open. Why? Because it had no ability to get up into it, close it at all. So that changes the fair value gap to what? A breakaway gap. Breakaway gaps remain open until lower level objectives are fulfilled and delivered and booked. In other words, it goes lower to a specific price level in the discount. Then at a later time, it might come back up to here, but it could be an undetermined amount of time. I don't know when they'll come back to fill in a breakaway gap. And if it's bullish market, everything I just said, just reverse it. This last up close candle prior to the move lower and taking out that dealing range low, that is my ICT bearish order block. It trades lower, comes back up, doesn't really quite get back to that old low, sells off again, then it comes back, ramrods this low here, goes above it, and then consolidates. So anyone that would have expected this little bit of fluctuation through, this would have wore them out. These are days. These are days of trading, S&P. Shorts are going to be scared. It's probably going to go higher. Why? Because they see a bull flag. Run up, consolidation, and they expect it to go higher. We're bearish. We're in a premium market, and it's going to a bearish order block. Now, price is likely to drop lower and reprice and target what? What's it going to target? If this is your trade, what's it targeting? Well, think about what I taught on this YouTube channel, flagship pattern, the optimal trade entry. From high to low, 79%, 62% retracement levels. That's here. That's my optimal trade entry. So you can use targeting approaches where you put the fib on the bodies here and here, the lowest of the opener close and the highest of the opener close, and your projections down would be red in here. But we have a fair value gap that's left open, bearish order block, a dealing range that's been broken to the downside. The only thing we've done is retrace back into a short-term premium, and retail traders are going to see a bull flag. We're looking at it to go lower. What's it going to go lower for? Before we get into that, we have a short-term low that's taken here. So we had sell side here, and it starts to rally back up. What's it reaching for next? It's going to revert back to buy side. That's this here. That's why it's not going to go to simply that level and go lower. It's going to go deeper then to clear off all the buy side liquidity so that way it can absorb that buying orders and translate that to a short position for smart money. So the counterparty is the buy side being attacked here. So shorts in the smart money camp can then target that low down here. So we have buy side taken here. The sell side was taken here. So now the sell side changes to here because the dealing range is now defined by this low and this high because buy side was taken on this high, sell side was taken on this low here. So we have a dealing range here. How do we find that useful? We're bearish. So even though this is a fair value gap close to around the equilibrium between this low and this high, that simply would just be a partial. And we hold for what? Sell side to be attacked. But look closer in here. What do you see? Let's zoom in. So here is that area here. And inside this own area of shadedness, I've taken your attention to this short-term low here. So we have a short-term low here, and then it gets taken out, and then we have this low here, and it starts to rally up. Look close. Do you see that this is a swing low? Again, these are daily candles. They're not lower intraday charts. We have a low that takes out sell side here. Runs down, creates that low. One more smaller attempt to go lower than this day. It does. Then the following day, we open, trade down, and trade back up. This is a swing low on a daily chart. After we've taken out sell side below here, and we have a short-term sell side liquidity pool here, which it runs down into, and then creates a swing low. So we're in a discount inside of a discount. Think about that now. If sell side's been taken here, and sell side's been taken here, what's it going to revert back to? Buy side. Where's that? Swing high on a daily is here. So if it's going to go here and run to that level, buy side is simply not just that at that level. What's above that? Bingo. Our gap. Notice how we had sell side taken here, and then the market reverts back to buy side and to an imbalance, that gap.